The past week has set the stage for some new highs in the market, but let's start with Jerome Powell's latest rate cut announcement at Jackson Hole. Despite widespread fear, anxiety, and even skepticism leading up to the event, those in our community saw it coming. The media may have acted surprised, but we understood that a rate cut was likely. Powell's dovish tone is precisely what the market needs to fuel the next bull run. With inflation easing and the labor market softening, the Fed now has room for more aggressive rate cuts, aligning with its dual mandate of controlling inflation and managing employment. Inflation has dropped from its peak at 9% to around 2.9%, bringing it close to the Fed's 2% target. Meanwhile, rising unemployment, a key concern for the Fed, could spark larger rate cuts. Remember, unemployment doesn't increase steadily, it can spike unexpectedly, catching many off guard. The Fed's focus has now shifted from taming inflation to stabilizing employment, signaling a possible shift toward more accommodating policies. This setup could take markets higher throughout the year. However, it won't be a smooth ride. A significant correction may be on the horizon. Economic data or a tech sector slip-up, think of Nvidia missing earnings, could trigger a short-term dip. But this won't catch us by surprise. We'll treat it as an opportunity, understanding it as a temporary setback before the ultimate climb. So, here's what you should do: brace for a possible September correction. When it comes, remember that it's just an opportunity to reinforce your portfolio at lower prices. Many will panic, but not this community. We'll know it's a buying chance, a temporary dip ahead of the final surge. Before the anticipated November-December bull run, we'll see one more drop that will likely shake out less informed investors. But for us, this drop offers a chance to solidify our positions. Why am I so bullish? We're at a record $6.24 trillion in money market accounts, the highest in history. While not all of that will flow back into stocks, around $1.5 trillion is expected to. That's from investors who feared a tough 2023 and now need to re-enter the market, especially as time runs out for professional money managers who can't afford to sit on the sidelines much longer. These professionals are also watching for the next dip, just like we are, waiting to buy in before the bull run takes off. When it comes, that cash on the sidelines will flow back into the market, propelling stocks even higher. But it won't be an easy path. We'll see volatility and rough patches. Beyond that, we're witnessing a technological revolution with AI at the forefront. Nvidia, whose revenue from data centers has surged, leads this revolution. Former Google CEO Eric Schmidt has even projected that hyperscalers will invest $300 billion in Nvidia's products alone over the coming years. This indicates a paradigm shift, and Nvidia's performance this year will be crucial for the entire market, with its earnings announcement on Wednesday being a potential guide for short-term moves. I expect Nvidia's earnings to be transformative, demonstrating the pace of the AI boom. If earnings meet expectations, we might delay a major market dip. But a poor report could accelerate it, bringing the correction closer. Either way, my strategy remains clear. I'm waiting for that correction, prepared to invest wisely when the time is right. As we move toward 2025, remember that true long-term value comes not from reacting to media-driven fear, but from understanding market fundamentals. Mainstream analysts may fuel volatility, but for us, any dip is a buying signal. So, let's stay grounded in strategy and seize the upcoming opportunities. When the market trembles, be ready to invest. After all, when there's blood on the streets, even if it's ours, it's time to buy. Stay focused, stay prepared, and I'll see you in the next one.